Welcome back to another video and welcome to Reinvesting. Today, we're going to speak about how poor people investing compared to rich people investing. I've always been curious as to why the healthy remain wealthy. The poor, on the other hand, remain impoverished. This is a simple question with a simple answer. Their investment decisions. We'll show you that today in today's video. Poor people invest differently than wealthy people. If you want to understand the methods you must first become affluent if you want to be wealthy like them. Continue to watch the video to the end. Not only in developed countries, but also in developing countries, despite the fact that security is better in investing in your home nation, the majority of the wealthy are not subject to any laws. Their physical handicaps, they do a lot of research and put a lot of money into it. In many countries where they may rest assured that their data is secure, investing is risk-free. They don't provide excellent returns, but they do provide adequate returns. Emerging market investments should be avoided. As long as they stay within the confines of their investment strategies and portfolio management. The poor, on the other hand, will suffer, fearful of investing outside of their comfort zone. The majority of poor individuals fear losing money because they fear losing money. People are apprehensive about taking chances. They will only be comfortable in their own skin. Cocoons and only leave them on rare occasions. It has something to do with holding a small child in your arms. You fry and it'll crumble. As a result, the poor are more likely to remain poor. They are poor because they are not allowing themselves to grow. Number 2, invest in a diverse portfolio of assets. Some people may believe that they are limited in their abilities. Make an investment in a certain asset class. The most valuable tangible assets are mostly individuals born their perspectives. Input money in both tangible and intangible assets. Both tangible and material, you will observe that a wealthy person has investments in bonds and stocks, both residential and commercial properties. There's gold and land, to name a few. They usually have a wide range of abilities. They have a portfolio that protects them in the event that they lose their job. The quality of one's work in one area deteriorates or is swayed by market forces that aren't working in benefit. The impoverished man will likely emerge in the direction of putting money where it's needed based on their financial capabilities. They are cautious to invest any funds in it. Possessions are tangible, such as real estate, as a result of the fact that the significant financial investment required. In addition to the fact that this isn't always the case, liquidating real estate assets is simple. Poor people are more likely to invest their money. Bonds and stocks or certificates are examples of assets held in trust. They're easy to invest in and have a lot of liquidity. The third option is to invest in private markets. Even the wealthy are well aware that this, so that you might gain more wealth. Putting your money where your mouth is a wise idea. In the business world, rather than working for the government, public opinion is influenced by a variety of things, entities that are normally considered to be the property of the governments. The majority of them make a small profit. The situation is mismanaged and decisions are taking too long to be made, resulting in the squandering of the chance because of their bureaucratic nature. Private firms, on the other hand, are a different story. More aggressive and in the vast majority of cases, successfully managed with specific accountability requirements and having the ability to perform at a high level, as well as earn extra money for the wealthy. Private business brings a lot of money. As angel investors, they invest in a variety of businesses. Investors and business owners, it is possible that the poor will not be able to afford it. invest a large sum of money in a private business, and the stock they acquire could be extremely valuable. A bad performance may be deterred as a result of this. Stopping someone from investing in such a company, there will be full competition in which a wealthy individual will compete. He focuses, like a person will focus on his company plan and how he puts it into action to compel them to follow through with his plan's lower objectives. What matters most is that he achieves his goal. The investor isn't always aware of what his neighbor is up to when making a business plan. This has taken a lot of consideration. To guarantee that all market factors are considered, there are dangers that have been discovered and are being mitigated. This gives the owner of the business a peace of mind. In order to fulfill his goal, on the other hand, a wealthy investor will always be affluent. He is aware of the events taking place around him, but he isn't going to let himself go. Those who were poor were misdirected. They are always keeping a close eye on what they're doing and what their neighbors are up to with a view to adhere to their example. This can assist you in getting ahead of them or even surpassing them. They are sidetracked from their main activity on occasion. This competitiveness is harmful to your health. It has the ability to put you in an uncomfortable position. You always copying what others are doing. Businesses are involved without first doing some research and finding your route. A shrewd investor will most likely take profits, all of his profits, nearly all of them. They brag about it instead of showing off to their friends. Reinvesting in the expansion of their business, the wealthy will certainly build their own dwellings. Businesses will continue to exist until they are no longer viable. Surplus profits from the business will buy their illusions and wants. Number 5, when you do, make sure your investment portfolio is well balanced. Not ensuring that your investment portfolio is well balanced, it's possible that it'll tip in the wrong direction. In contradiction to your plans, the wealthy exercise extreme caution in this regard. Through an assessment of their investments, they are balancing their portfolios in addition to the course their own from time to time. It is critical to ensure the portfolio security and that it maintains its equitable distribution and keep the desired level of diversification of the best investment strategy for the inexperienced investor. This may not always be the case. Primarily because of the small size of his investment, it does not have a diverse asset portfolio. Number 6, the saving strategy of the majority of wealthy investors have a money saving strategy that they stick to save money in order to become wealthy. The wealthy are aware of this even as they amass wealth. At this time, they must also save money. It is a wise decision where the outflow of the cash is less than the inflow of cash. Increasing cash flows lower the chances of going bankrupt. Being on the incorrect side of the ledger or being on the ledger publications of yours. Living below one's means is how this phrase is translated. A method of subsisting on less money than you earn, it will eventually have the time you employ it in order to achieve your financial goals. The poor, on the other hand, are marginalized in the vast majority of cases. Thank you guys for watching to the end, and please subscribe for more videos. See you guys in the next video.